If you ask most retirees what their biggest financial worry is, they'll usually say the stock market. And sure, market volatility is scary, but in reality, there are three major risks that can quietly erode your income in retirement, and the market is only one of them. Today, we're going to unpack what I call the retirement risk triangle: market risk, tax risk, and longevity risk, and how to build a plan that protects you from all three. I'm Cary Green, financial advisor and co-founder of Green Era Financial, and I help people close to or in retirement to get the most out of life with their money. So let's get into it. So let's start with the first side of the triangle, market risk. This is the risk most people think about, the ups and downs of your investments. Now, when you're still working, market volatility is uncomfortable, but it's not devastating because you're still adding money to your accounts. In retirement, though, the equation flips. You're usually withdrawing instead of contributing. And that means a bad market early in retirement can hurt you far more than the same downturn later on. It's something called sequence of returns risk, and it's one of the most dangerous forces in retirement income planning. So let me give you an example of how this works. Two retirees could have the same average returns over 30 years, but if one experiences negative returns in the first few years while also taking withdrawals, their portfolio may run out of money 5 to 10 years sooner than the other. So how do you manage this? By diversifying your sources of income. Maybe keep a few years of spending in safer assets like cash or short-term bonds. That way you're not forced to sell growth investments when the market is down. So think of it as your buffer against volatility. Now let's move to the second side of the triangle, tax risk. Many retirees underestimate this one. After all, you might think your tax bill will drop once you stop working. But for many people, it actually goes up later in retirement. And here's why. Most retirees have the bulk of their savings in pre-tax accounts, like IRAs and 401ks. And at age 73 or 75, the IRS forces you to start taking required minimum distributions, whether you need the income or not. Those withdrawals are taxed as ordinary income, and they can push you into a higher tax bracket, increase the taxation of your Social Security benefits, and even raise your Medicare premiums through IRMA surcharges. This is why planning ahead is so important. During your early retirement years before RMDs start, you often have a window of low taxable income. That's the perfect time to do tax planning. Maybe, for example, partial Roth conversions, strategic withdrawals, or capital gains harvesting. By filling up lower brackets now, you can reduce your tax exposure later. And the goal isn't to pay no taxes, it's to pay them on your own terms. And finally, the third side of the triangle, longevity risk. This is the risk of outliving your money. It's not a pleasant thing to think about, but it's real. Life expectancy has steadily risen, and many healthy 60-year-olds today could easily live into their 90s. That means your retirement might last 30 years or more. The longer you live, the more time inflation, market downturns, and healthcare costs have to compound against you. Now, the solution here is twofold. You plan for sustainability and flexibility. Sustainability means your withdrawal rate, investment mix, and income sources are built to last through a long retirement. Flexibility means you adjust as life happens, spending less in down years, rebalancing as needed, and taking advantage of opportunities when they arise. The retirees who do best aren't the ones who guess perfectly. They're the ones who adapt intelligently. Okay, so let's step back and look at the full picture. Market risk threatens your portfolio value. Tax risk threatens your take-home income, and longevity risk threatens your time horizon. A solid retirement plan protects against all three by balancing growth and safety, coordinating your accounts for tax efficiency, and ensuring your income strategy lasts for decades, not just years. And at Green Era Financial, that's exactly what we help our clients do: design retirement income plans that are resilient, tax smart, and built for life. So if you'd like help building your own version of that plan, you can always feel free to reach out to me directly or visit us at greenerafinancial.com. I'm always happy to help if I can. Thanks for watching, and I'll see you next time.